precious metals this morning, talk about this gold bull run that we've got going on. So I'd like to invite my panelists to the stage. I've got Angelos Damaskos from Sector Investment Managers, Charlotte Peuron from Credit Mutuel's Asset Management arm, James Luke from Schroders, Loni Saul from Kings Road Capital Management, and Jonathan Guy from Hannam Partners as well. I think it would be great to delve into this, the macro behind where we feel we're at with the gold market at the moment, and some of the psychology of investors right now. We've got this wonderful gold price, but equities are perhaps are lagging, and perhaps that's because of the global equities situation. I don't know, but you, as the experts, I'd love to get your view. So, Angelos, do you want to give us your take on where we're at now and what some of these macro drivers what are they creating amongst the psychology of investors at the moment?
Yes, thank you, Adam. First of all, I think the market is still very sensitive and
it's on.
It's on. And uncertain as to the trajectory of the equity markets and the economy. I think it's split into two camps. One camp argues for a soft landing, i.e. a very shallow recession, perhaps even no recession at all. And another argues that we may be heading for something much more serious and more protracted, excuse me. But one thing that almost everybody universally agrees is that the economy is not doing extremely well, and it's flatlining at best. The question is, how will the central banks address the situation in the medium term? They have raised the interest rates very aggressively over the last year or so. There are indications that they are harming several sectors of the economy, i.e. the banking crisis we've seen recently. There are question marks about the property sector, about the high yield sector, which many issuers are coming to refinance high yield issues in the next months and so on. They will find their interest rate cost is going to be 3 or 4 times what it used to be. So there are going to be possibly other corporate debacles that could destabilize the market. And I think that makes investors in general being cautious and staying on the sidelines away from the so-called high beta equities, i.e. the equities that are correlated to market moves. And universally, I think mining equities are classified as high beta, being more volatile than others. So notwithstanding what the actual commodity is doing that impacts the earnings of the miners, there is a general reluctance to participate in the sector because of the wider market concerns. Now, if we look at gold as a metal and what it's been doing, obviously it's been range-bound for 1.5 years now. We saw an all-time high in 2020. We sort of attempted to breach it in the last few months. We sort of attempted to breach it with the Russian invasion of Ukraine and failed. We've attempted to breach it recently, but it looks like there is a sort of a developing pattern of trying to breach these previous all-time highs, which is roughly 20,775. And I think most people think that if we breach 2,100 convincingly and stay above that level, that could trigger a lot more interest of investors in the mining stocks because they are obviously making a lot more money, bigger profit margins, more cash flow generation. So that's a key sort of target price level. Now, what will it take to get there? No one knows. It looks like we are flirting with that level at the moment. Central banks, particularly from emerging markets, have been buying gold. They have been the main buyers of gold bullion in the last 6 to 9 months. And that has been caused by the Russian sanctions, seeing that the West could use their monetary tools to block completely a hostile country. That causes the Chinese, the Indians to think what could happen if we are in a similar situation. And that, causes the trend to diversify the monetary reserves. Now, if the general investor starts thinking along those lines that they should increase their holdings in gold bullion to protect their portfolios in terms of safe haven and store of value, that is the trigger that would sustain prices a lot higher. And from there on, if we break 2,100, no one knows where we could go in this environment.
So the generalist investor is not there yet, and the institutions are not there yet as well.
Well, the institutions are not there because they are not getting inflows into the funds. You know, especially fund managers like ourselves, if we don't get fresh liquidity from investors to deploy into the sector, we can't do very much. You know, we run portfolios, we try to sort of trim holdings or manage positions, but we can't deploy significant new cash. So it's kind of a vicious cycle. When investors, the generalist investors, start getting interested in the sector, they will invest not only the equities, but they will invest into funds, and then the funds will be able to finance the more special projects. And I think that goes in line with that critical trigger level to generate a lot more interest.
Yep, excellent. Charlotte, why don't you introduce yourself as first time speaking for one-to-one as well, and then we can talk about your views on some of these macro headwinds.
Yes, so generally speaking, I agree with you. Yes, we think the gold price will stay high, but with a high volatility. So I think it's a good time today to invest also in gold equities, because especially the junior or exploration company like here, because their valuation are very, very low. So, but and I think the larger producer, their valuation are, in my opinion, are at fair value today. So but for a junior company, yes, it's a good time.
So you think the producers are fair value? Sorry, Charlotte. Yeah. The producers are at fair value because of the cash flow that they're generating at this price, right?
Yes, the larger producer continues to generate high cash flow. Yes, that's right. But we think it's today it's. This cash flow are included in the valuation of this stock, and the most critical issue for this stock is to replace depletion. And we have seen today it's really difficult, but I think we will discuss about that during these sessions.
Yep.
So. Yes, the larger producers, yes, generate cash flow, but they don't invest enough during the last the previous years in exploration, and today it's really critical. So.
Yeah. Well, we need to get onto the reserve replacement challenge, and I think we'll come onto that. I want to ask you actually just about your fund as well, and your investors as well. The psychology of the investors. You mostly have European-based investors looking into your fund.
Yes.
And how do they like gold and gold equities?
Yes, our investors are mainly French investor and South European, like Spanish, and a little bit German investor and Belgium. So, but the main are French, and yes, in France, sometimes it's mining industry have a bad, as you know, reputation in France due to often environmental issues and sometimes pollution, and especially sometimes for gold, because gold is not a critical metal today for the energy transition, for example. So, but French investor wants also gold to protect their portfolio.
Yep.
So, against volatility, against financial risk, yes. there are a lot of risk today in the financial market. So due to the bank crisis in US, for example, and people want also gold to protect their portfolio.
Yep.
Yes.
So it's very much that hedge play. Yep.
Yeah, it's a hedge play in asset allocation, finally.
Excellent. Okay, great. Loni, first time we've had you speak as well with one-to-one. Please, could you introduce yourself and the investments you look after, and then we can talk about some of these macro topics.
Basically, I'm running a fund focusing on the junior mining space, anywhere from early stage exploration to development and production, covering precious and base metals.
Excellent. And what's your view at the moment? You know, as a fund manager, there's great opportunity now for some of the sort of dislocation between the valuations that we've...
in my area, I think the values are attractive, but the momentum is not there. So it depends how you want to take it, really. Yeah. I mean, if you're a patient guy and you see the value, you can buy and wait. But I don't see the trigger of the liquidity, the excitement that will push the prices higher now. It's just, I think the Fed moves have created this environment where anything that requires a lot of time to create cash flow is put in the back burner because money is more expensive than before. So that's one problem, I think. And the risk appetite has declined over the last 18 months as a result of the Fed move. And I think even when I look at the headline of this panel, you know, it says investment strategies in this precious metals bull market. I am not 100% sure we are in the bull market yet. I mean, gold looks the best of the precious metals. But if you look at the GLD holdings, the investor appetite is not there. I mean, the quantity of holdings in GLD, for instance, shows that. So you would see institutional money coming in when you see more holdings within GLD, for instance. So the prices are relatively high in gold. I would admit that. I mean, we are challenging the all-time highs. But if you look at the likes of silver, platinum, palladium, the story is different. So it's not like we are in a broad bull market. I mean, gold is obviously looking good, but costs are cramping up as well. So in a way, the profitability of many of the miners are not much better than a few years back, maybe. So as I say, you know, I'm not saying it's a bad market. Obviously, for gold, it's sort of okay, but I don't think the excitement is there yet.
Yeah. And we talked about triggers, perhaps psychological barriers. Do you think there's any triggers coming that's going to change that appetite, or
I think liquidity.
Protracted?
Liquidity is the big issue, right? I mean, especially in the junior mining space, I see that we don't have much new money. So if a story pops up and it creates excitement, it obviously the prices will go up in that stock. But you have to find that few stocks that will really perform. It's not like there's enough liquidity to lift all boats, because in a bull market, that's what you basically get, where pretty much any story is valued higher because people have more appetite for exposure into the sector. And as I said, I don't think we're there yet.
Yeah. Okay. Jonathan, what's the view from London? And
well, I mean, I think let's just start off with gold. I mean, obviously it's been a decent few months for the metal, but it's not a one-way street. And so yes, we've seen Western investor buying and central bank buying picking up, but we're also beginning to see a bit of demand erosion. So if you look at the World Gold Council Q1 demand trends, which was out a couple of weeks ago, we began to see the Indian market which is more price sensitive, beginning to roll over. Yes, there's still strong demand out of China. That's something of a recovery trade. But those Asian physical markets are much more price sensitive. So if you see that big move up in the metal, driven largely by investor buying out of Europe and North America, that will result at some point in a pullback in Asian physical buying. And so at the moment, what we're seeing is the metal being pushed up by people having concerns about the economy. I guess people are probably looking at the debt ceiling over the next month. That will almost certainly be resolved at some point, but it represents a short-term systemic risk. I think you look further out than that, and you look at, I guess, commercial real estate, particularly in the US, and there are some big risks there that people probably want to hedge against. So I think people are positive about gold, but certainly generalist investors, my sense is that they still aren't there with the equities. They would be they would usually be sort of reasonably late to the party, and so I think there is still not that positive sentiment there. The equities themselves, looking across the board, the key theme is obviously one of consolidation, with the most sort of emblematic transaction at the moment being Newcrest and Newmont, and it'll be interesting to see what happens with the money that ultimately comes out of Newcrest. Do investors in that company continue to hold shares in Newmont, or do they reallocate it back down to the tier below? Does that stimulate the next round of mid-tier companies, which in turn stimulates the next round of junior companies? But I agree with the rest of the panel in that the market's just not there yet. Perhaps some of the seniors are looking okay valued, but certainly the second and junior tiers still aren't there. And the reason why we're seeing M&A is because people haven't done exploration for long enough, and that brings us back round to this conference and many of the companies here, in that people haven't been replacing resources, they haven't been replacing reserves, and so you really do need to see funding going into exploration, which develops new projects, which can then be developed or bought up by medium and larger mining companies to sustain their production moving forward. But at the moment, it just doesn't feel to me as if there is that weight of money going into the juniors and some elements of the mid-tier to drive a rally, and certainly not new money flowing into exploration stories other than very selectively to drive a broad sort of rally in the sector. People are still looking at other parts of the investing universe. So there's a disconnect between a very strong performance of gold and what I think is actually a good macro story for gold, and an equity market which still doesn't seem to really buy into it.
Yep. And for triggers for the equity market, is it something like rates coming down, Fed changing their stance, and sort of gives people less of a risk-off mentality in the near term?
I don't know in some ways, because I think what we have seen is if the Fed were to sort of fully pivot, start cutting rates, then there's a whole bunch of risk assets in the tech space and crypto space which I think would probably rally harder than gold. Yeah. And almost if you see that quite significant rate move, then I suspect gold and gold equities would probably get left behind. You want to have an environment, I think, where there are sort of concerns about systemic risk, which gold acts as an effective hedge against, which means that non-price sensitive Western buyers are prepared to continue to put money into ETFs. And I guess there's a separate story going on about central banks, or certain central banks, wanting to increase their gold holdings to perhaps be able to de-dollarize at some point. Yeah. But I mean, the de-dollarization story, I think, is a whole separate debate.
Yeah, we could come into that. It was quite interesting what the BRICS countries are sort of doing, including the way the world's dividing as well. But yeah, let's keep on with the equities piece then, and talk about opportunities in the sector and valuation. Is this a buying opportunity now to sort of take up the positions and hold for when we do get these triggers, sort of changing the psychology in the market? Jonathan, do you want to back on us?
Yeah, I mean, so just if we look at previous cycles and what happens with the gold equities, you get this golden period when the gold price runs and the equities can make supernormal returns over an 18-month to 2-year period. Now, gold doesn't rally in isolation. So if gold's rallying, then you'll see other things rallying at some point as well. Then inflation catches up. And, at a very basic level, if you're a bloke working on a mine and you suddenly see the company's making lots of money, you'll be asking for a pay rise or a big bonus. And so, there's an 18-month to 2-year period now where you'll see that the margins increasing again for the companies, and that should enable them to increase exploration spending. That should enable them to increase dividends and make themselves more attractive to investors. And it means that they're in a better position, because it isn't like 2011, 12, 13 where people had horrible balance sheets, or the cycle before that where people had horrible hedge books. People are actually there hasn't been lots of crazy M&A. The companies actually are in pretty good state, chucking out decent cash flow at these levels, and so there is the ability for them to start consolidating down the tiers, and that should drive equity valuations for the juniors in the mid tier. And you've got this ongoing problem of reserve replacement.
Which are the more attractive sort of companies at the moment? You're sort of saying earlier, you were saying capex is obviously a big issue. So maybe producers, Charlotte, you were mentioning that you think they're priced in. So the good value options is sort of near-term developers, as we always talk about. Where do you see the best opportunities within the tiers of miners? Anyone? Yeah.
Well, I think we have seen a big problem with development recently, where capex estimates have been totally inconsistent with reality. So anybody has done their feasibility study a year back, for instance, might be looking at totally unreasonable expectations. So the inflationary impact of developing companies has been a big issue, I think. So if you want to look at that space, you want to basically look at a company that's pretty much done most of their mine built or tied up pricing for capital spending items, because that has been a very big risk. The other big risk that I've seen is getting worse and worse every day, I think, is permits, basically, environmental permits. So if you want to look into the sector, obviously, if it's a permitted mine or if it's easier to permit, that's a very, very important lens to see the things. I mean, so if you want to basically go just a stage below the cash flow generating companies, and you want to get to a company that's going to be producing soon to catch this cycle, those are the two things I would pretty much recommend to focus on.
Yep. Charlotte, you look like you wanted to jump in. What are the best assets to hold now?
Today, I think the best asset or the best company you own today could be a junior or explorer. Yes, because a larger producer or a junior producer can buy a new discovery. You see, but yes, it's still risky. But larger producer need to build, for example, camp to increase synergy and to develop a new mine. And in this case, they can invest in exploration company. You see, for our fund. Our strategy is to invest across the whole spectrum of gold miners, from the larger producer to explorer. Why? Because we think diversification risk is really important, and you have less risk for a larger producer and more, of course, for explorer or for single asset producer. So, and we need also a liquid stock, because we manage open fund, and with the high volatility of the market, we can have a high redemption or subscription. So, and we have to be able to react quickly. And a smaller company, generally speaking, it's more difficult. And
so, what's your weighting? And you're sort of quite evenly balanced between producers, mid-caps, and
so explorers. Roughly. In our fund, we own roughly 25% of larger producer, and roughly between 25 to 30 intermediate, and after junior producer and developer, we own roughly between roughly 20%. So, and we have also a small metal diversification, because we can invest also in copper producer.
Right.
Yes, I like copper producer producer because often they produce also gold. Yes, it's the same deposit as gold and copper, so it's easy. And so we are confident also on copper price, of course.
Yep. Copper's an interesting story as well. Excellent. Okay, Angelos, how are you diversifying or sort of pivoting in this environment? What's the best assets for you?
Yeah, I think most analysts agree that the precious metals mining sector is undervalued, especially if we see the context of the medium-term trajectory of gold prices. And it seems like we are shifting now the plateau of medium-term analysts' price that they use, whether it is 1,500 or 1,600 or 1,700 varies between different outlooks. But the point is that the mid-cap and the large-cap producers have been making a lot of healthy free cash flow in the last couple of years. And notwithstanding the concerns about the cost inflation and capex inflation and labor cost inflation, etc., it seems that the gold price appreciation has outpaced the escalation of costs. So the margins are expanding. And the question has been, why are these companies that are flush with cash, they have paid down debt, they have started sort of paying dividends, why are they not buying other companies, smaller companies, to replenish their reserves? And I think it goes into the same sort of vicious circle of the market sentiment that management teams have been battling with their shareholders for capital returns and dividend payments, and they don't feel they'd be rewarded by the shareholders for a risky acquisition. So we have seen mergers of the mega miners to create even larger companies. We have seen mergers of equals, but we haven't seen large companies buying earlier stage projects or development stage projects to replenish their reserves. A very interesting outlier was yesterday's announcement of Fortuna, who bought this Minnow Chesser in West Africa. Very early stage project with just 860,000 ounces of gold, not particularly high grade, 1.8 grams, but it has a huge tenement. So obviously the objective of a large company like Fortuna buying there is the exploration aspect. But exploration in this business takes years, takes 7, 8, 9 years to come from identification, discovery to production. So in our view, most of the activity will likely come when we start breaking this threshold of 2,100. Investors will become much more open-minded to growth. They will start asking questions to the management teams. What are you doing with all this cash? Where are you going to deploy it, etc.? And that will trickle down to corporate activity. And perhaps I believe that it will center mostly on brownfield sites, projects that have a relatively short time span to production and a short outlook. So either past producers that have relatively higher marginal costs, therefore need a higher gold price to become profitable. These are going to be attractive because you can deploy cash very quickly, you can bring them back to production quickly, add to your mine reserves, etc., as well as add to exploration. Earlier stage exploration projects are probably next, but they require a lot of momentum, a lot more momentum to go through that phase and trickle down to the smaller ones. So at the moment, I'm mostly focusing on these sort of brownfield sites, which I think will be likely the center of corporate activity if we break into the new sort of paradigm of bull market.
Yep. And are there lots of them out there? Are there sort of quite?
Yes, there are lots of them. But where one has to be very careful is the actual economics of a project, because there are lots of sort of doer-uppers who are buying, historical producers. They say, okay, we can bring them back to production cheaply. It's so and so. The previous management team missed that. They made that error. This and that. You have to really dig deep and understand if that holds true and if it's viable, and most importantly, if the management team has the credibility and the track record to deliver. So in this game, I think management team and quality is the number one criteria, but also you have to focus on the underlying economics of the project.
Mm-hmm. Yep. Excellent. So let's get into the reserve replacement challenge then. So a splurge of M&A has got to be coming. Jonathan, you touched on it earlier in your comments. Could you give a bit more on your view of sort of how the strategy maybe as to what is it going to be purely based around value creation and acquiring existing mined ounces, or maybe on this brownfield strategy that Angelos has mentioned?
Well, I think sort of fundamentally people put their money into gold mining companies because they want to make money, and so what they're looking for is leveraged exposure to the gold price. What they're not looking for is leveraged exposure to political risk and security risk, or leveraged exposure to capex blowouts or environmental permitting problems. So what are larger companies going to want to buy? Well, they're going to want to buy what they can then go and sell to their shareholders as a good acquisition. So I think if you look at the earlier stage stuff, if you've got large projects that can deliver reserves of more than 3 million ounces capable of sustaining production of more than 200 to 250,000 ounces a year, that's always going to be popular. If you've got a mid-sized project which is oven ready in a low political risk jurisdiction, capable of sustaining production of 150, 200,000 ounces a year plus, those are the ones that will go relatively soon. I mean, you want something that you can bring onto the books and then move forward. Rather than something that's going to be stuck in sort of design and development or permitting hell for the next 10 years. Yep. Those, I think, are the ones that move next.
Yeah, and within that, thinking of the permitting and the sort of jurisdictional challenge, where's good? West Africa's having a lot of good examples over the
West Africa's
years.
Mixed. I mean, but at the moment, I guess you'd look at someone like Burkina Faso and go, you've got multiple coups, you've got a large-scale Islamist insurgency in the north and east of the country. Why would you put your money there? Yet Endeavour, which is a highly rated and low-cost mining company, is chucking off cash like a drunken sailor and has quite happily managed to operate assets there. So Orezone, for example, in the south of the country, have just brought a mine into production with all-in sustaining costs at Bombora of less than $1,000 an ounce. So there's, Mark Bristow, now CEO of Barrick, used to say when he was CEO of Randgold, it's not about risks. There's risks associated with all projects. If you're operating in Montana, you've got environmental permitting risk. If you're operating in West Africa, it's about political security and logistical risks. It's about how you manage those risks and do you have a team in place that can effectively do so. So I don't necessarily think that West Africa, because it's more challenging, is off the table, because all of a sudden there is a scarcity to these assets, and if all of the FSU and particularly Russia is suddenly off the table for many investors, then you're pushed towards West Africa, where you do have a stable gold mining industry, or other parts in Africa. I think South Africa is probably harder and is remains very much a sort of special case. But those who've been bought in the last couple of years, it's been that ongoing consolidation story, particularly amongst the Canadian mid-tier. So who is going to step up and fill the gap left by all of those guys being taken out? That I think is an interesting area, and the ongoing sort of re-optimization and moving forward of various parts of the gold mining industry in Australia, where you don't have the political risk, you don't have the permitting risk in the same way, and you've got world-class engineering skills and everything on the doorstep. I think Africa, ex-South Africa, North, particularly Canada and Australia would be the sort of focuses from my perspective. I think parts of the world have got more challenging, and I guess particularly somewhere like Peru in the last 6 months would be a good example of that.
Yeah, true. Okay. Anyone have any questions for the panelists or want to probe our panelists? Gentleman at the back, yeah.
I'd agree with Angelos' comment about the fact that anyone who wants to build a mine right now must be a little bit mad, because in Australia or Canada, the cost inflation is out of control and your stock gets totally smashed. And even if you do discover some decent holes somewhere that looks like a 2 million ounce deposit, as Jonathan said, it'll take 10 years to permit. So I think there's fewer, as Jonathan said, it's nice to buy those 200,000 ounce mines, but there's not many of them. And so I think that what Angelos is saying about that the small mid-tier producers are going to massively re-rate, because they're all going to get gobbled up, because a lot of those are probably underfunded, and with a little bit of funding, they can massively grow their mine life and also expand. So, because the big guys can't just keep buying the big guys, I guess. So, I don't know, Loni, what do you think, mate?
Well, I think when we look at the M&A action, we've seen various strategies being played. Like Fortuna's move yesterday was, to me, a surprise. I knew the target. I thought it would be a potential target in the future. I was totally taken by surprise when I saw the deal. Great Bear was sold without a resource. So we have seen that extreme as well. And we're also seeing, obviously, economies of scale efforts, which should always be the best idea for an M&A. So I think it all depends. Some people just do the M&A to diversify their jurisdictional risk. I mean, I've seen a Mongolian company step back buying a Peruvian company. Like, I mean, you can hardly combine the two in your mind. But I mean, things like that can take place. So it's hard to really pinpoint who will be taken over and who will be the acquirer, unless they're just neighbors there and you can see the economies of scale. I think we're seeing very, very different approaches in the M&A space these days.
Just make a comment that I fully agree with this, but it's because of the dearth of number of deal flow and volume of transactions. We just see a few outliers here, which are really entrepreneurial moves based on one company's sort of view, whether the Mongolian with Peruvian synergies make any sense, or whether Fortuna makes sense to buy such an early asset is really not easy to understand. But the question is, when will the sector in general, the management teams in general, come into the conclusion that they need to buy growth and replenish the reserves? And what will they buy? Will they buy near-term production, a brownfield site, or will they venture into the earlier stage, sort of potential blue sky of exploration projects? And I think it's going to be a sequential event depending on how the market moves and the momentum created in the sector. Management teams are investors too. They are driven by the same animal spirits, if you like. So they will, in my view, will likely play safer first, buy something that has a very close outlook to production, and it's relatively lower risk, where they can mobilize their balance sheet and fund it to production easily and reap quick rewards, rather than venture into very early stage exploration that will take years and has a lot of other set of risks.
Yes, I agree with you. I think gold sector is a very fragmented sector, and M&A could reduce. And I think this sector needs consolidation to be more attractive for investor with a larger company. Yes, the smaller company need to diversify their risk also, as you mentioned. And M&A is, I think, a good solution for that.
So, I mean, a few years ago, I was working at RBC, and we did a lot of work on valuation multiples over time, NAV multiples over time, and there were three different populations that it emerged, and that is those who produced less than 250,000 ounces or had one operation, those who produced between 250,000 and 1.2 million ounces a year, and those who produced more than that, sort of the big sort of people like Barrick and Newmont and so on. And the tier that attracted the highest price to NAV multiple over time was those in that 250 to 1.2 million ounce a year level. Below that came the tier one miners, which sort of more tracked the gold price, and below that the third tier miners with sub 250,000 ounces a year. So if you've got a group of assets each producing sort of 100,000 or 80 to 100,000, you bring them together, assuming they've got some sort of logistical or management synergies, then getting them to that 200, 300, 400,000 ounce plus level, that seems to be the level over time that attracts the greatest price to NAV multiple.
Yep. Any other questions to the panel at all? Okay, look, Andrew, yes.
Yeah, it's more an observational. There's bit of a question, and it strikes, yes, this whole issue of the mining equities as investments. I mean, even the largest companies are pretty small. I used to say they're the same size as your average San Francisco online florist. You know, I mean, they're not big companies in the big scheme of things. But the problem is big companies in gold mining in particular, the synergies aren't that great. Almost the opposite. The bigger the company, the harder it is to replenish the reserves. There are all kinds of math challenges to bigger gold companies. So, I mean, I'm not sure how this resolves.
I think there are synergies there, though. I mean,
well,
if you're Barrick and you're going into bat with Caterpillar or a tyre manufacturer, you can get that.
Yeah, I'm not saying there aren't synergies. I'm saying they're not that great. And normally the synergy comes with you had these behemoths merging and you took out a huge swathe of wasteful management. And that was the main synergy.
Or at least one of the jets.
Yeah, at least one of the jets. We've got to keep one. So I mean, we've seen this. The agglomeration of large gold companies, it hasn't really worked terribly well. They're still small companies.
Or you could say the tech sector, in particularly your
is absurd. But yes, that's a different question. But for an institutional investor looking at what are the Aussies? I mean, you raised the point. What are they going to do? I mean, Newcrest was not a great company, put it that way. What are the Aussies now going to do? Aussie institutions going to buy that has a market cap that makes sense for an institutional investor?
What do you believe is the minimum market cap that makes sense for most institutional investors?
Well, in Australia, it's an odd mix of very large, and then there are quite a lot of smaller boutiques. But for the very large, I would say Newcrest was borderline.
Look, and I think it's a really good point because a lot of, particularly in Australia,
I'm not a Mac game, by the way.
No, but there's a lot of quite small producers who perhaps could merge together, but no, it would leave Australia without that sort of tier one global producer. But the Aussies tend to trade at quite a decent NAV premium. So as we saw with Newcrest going and buying Bruce Jack, as we saw with various other transactions in the sector, what the Aussies will probably do, or what they'll be forced to do, is take their highly rated paper and start acquiring
shareholder
overseas.
Value to North American shareholders through inept acquisition in North America.
That would be the
sounds great. Yeah.
But if you ask what they'll do, I think that's what they'll probably do.
Can I just throw another argument into the foray that it's the evolution of political risk and the appetite of investors. We have seen big shifts, for example, in Latin America, because of this leaning tendency towards the left in most countries and sort of expropriation moves or indications that the governments are becoming much more sort of nationalistic about their resources. Yet, there hasn't been such a negative move in West Africa, for example. People are happy to assume the risk of Mali and other territories that have a lot of instability, a lot of local potential civil wars and potential other governmental instability. And that has been particularly curious to me, looking at the global picture. And I think there is an argument to be made that Latin America at the moment is relatively undervalued compared to other regions, North America in particular, and even West Africa, especially if one starts considering the massive tectonic shift in the Eastern European landscape. Russia is out of bounds now. Most FSU countries are out of bounds. Even Turkish assets are questionable by investors. And certainly, Central Europe is becoming very questionable. So I think there could be another shift there, another opportunity in Latin American assets for a greater re-rating as opposed to other regions.
But it is an interesting point because if you look at London and particularly London investors, people put their money into Petropavlovsk, boom, gone. People put their money into Polymetal, which was and is a well-run business, good management team, international board, a decent portfolio of assets across the FSU, and all of a sudden just gone. And I think a lot of people I had investors saying to me last year, well, this was a great business and suddenly I've lost 85% of my money and there's no chance of me getting that back. Why on earth would I buy another gold mining company? This was a FTSE 100 company that went boom overnight. And that makes it challenging to get people reinterested in the sector, particularly I think in this market.
Yep. Excellent. Well, that's brought us right on to time. And thank you very much for a great discussion. So a round of applause for our panel.